Hey, everybody, this is Charles Dobbins. Welcome back to another episode of the Multifamily Investing Academy's podcast with me, Charles Dobbins, the multifamily attorney. And I am here with Joel Friedland. Got a lot to talk to this guy about. He's not like most of the other guests I've had on my show. We're going to find out what this guy's all about. He started when he was 14 years old in his landscaping business. I got you beat, Joel. I started a rubber stamp business when I was 12. Okay. I made rubber stamps. But the thing is, he's from Chicago. He started out as a broker. He was on the, as we like to say, he was on the dark side. And then he was incredibly successful, sold the brokerage, and then came over to where everybody wants to be, one layer below the top. He's an owner operator now. Now, Joel, do you know what the top is?
I don't.
The banks.
No.
Those sons of bitches. They, gosh.
All right. So I'm going to tell you something why we do not agree with you that the banks are the top in our case.
Okay. I love it.
We don't use banks. We don't do any loans. We buy 100% all cash, no mortgage. You know what?
Okay.
I hate banks. I have one banker. I know you have a banker that you like a lot.
Oh, no.
I have a banker that I like a lot. But we got into a lot of trouble in 2008.
Okay, so hold on a second here. Let's get one thing straight.
Yeah.
You and I are on the same page. All right. So we're on the exact same page. This is the reason why we got in trouble back in 2008 was because of the banks. So they are the they're the necessary evil, and now we're finding it what's going on now. But if you look at Joel's website, Brit Properties, BRIT Properties.com, right there he's got a line that says, "We are risk averse investors. Are you?" And when I read that line, Joel, my first thought was, well, the only way you can be risk averse is if you don't do deals with banks. And right there, and right below it, you're saying about how debt-free acquisitions with a track record of 95 properties since 1989. That's fantastic. That is great. So talk to me what happened in 2008. Give me the whole story, because you and I look to be about the same age. I'm 72. And so, so we've been through it all several times.
Yeah, I'm going to go back before 2008. You probably haven't had a lot of guests who go back as far as you and I do. And I want to tell you, first of all, I watched one of my favorite podcasts of yours was the other day with the guy from Praxis with Brian Burke.
Oh, yeah. Oh, I love Brian.
He is outstanding.
Isn't he great?
Yeah, he's great.
Straight shooter. You know you're getting the real story from him. Yeah.
Yeah, I've got to reach out to him and invest with him. I like that guy.
Yeah, he's a great guy.
Yeah, so let's go back all the way to 1981. They say that history repeats itself. I don't agree with that. History doesn't repeat itself, but it rhymes. You ever hear that?
Yeah. Oh, yeah.
It's similar. It's not exactly the same. When I was 22 years old, I graduated from the University of Michigan, and I went to work for a family.
And that was because you couldn't get into Boston College, right? Okay, stipulate that. Okay, go ahead.
I had friends who went to Boston College. They loved it, but Michigan was outstanding.
Yeah.
So in 1981, I sort of accidentally ended up working for a family business that was not my family.
Yeah.
Their last name was Podolsky. And it was a father, Milton, two sons, and a daughter, Steve, Randy, and Bonnie. And they owned 6 million square feet of industrial properties, 84 buildings. And a friend of mine introduced me to the dad. He had met him at a health club. And I went and I met with him and I interviewed with him. And he said, "Kid, I'm 63 years old. I own a lot of buildings. Interest rates are 17%. The market's in a terrible place. And I need you to fill up my buildings. You had this landscape business, and I know you went door to door to get the landscape business started." I said, in one weekend, I got 70 lawns. I said, what I'm going to do is I'll go door to door in industrial parks where you have empty buildings, and I'll cold call companies and ask them if they'd consider moving. He said, that's fantastic. Nobody does that. So in 1981, the problem was that interest rates were running at 17%.
Yeah.
Inflation was nuts. If you remember, it was a disaster. So people talk about 2008. To me, that was the fourth cycle that I went through, not the first. And this period feels a lot like 1981. Although rates are lower, they could go much higher. There is a historical
Yeah.
case that interest rates might go higher. So I went to work and I helped Milt and his family fill up all those buildings, and they were mentors to me. They did for me what you do for the people that you mentor. They took me under their wing and they taught me the business. And so for 43 years, I've been in the industrial real estate business. And as a matter of fact, Steve Podolsky, who was one of my first three mentors in 1981, there's a group of them, is still an investor with me. And I just had breakfast with him in Florida during the winter. And he and other investors that he introduced me to are still with me after all these years. But we talk about it. We say, it wasn't bad luck that I had 50 buildings in 2008 with loans. It was just not the right strategy for me, because I went into a depression when I thought I lost everybody's money. I had 200 and something investors, millions of dollars, 62 loans to individuals who had loaned me money as if I was, family for them because they trusted me. I guaranteed those loans $7 million worth, and I had 7 banks, and it all came crashing down in 2008. And you see that couch behind me?
Yeah. That's where you slept.
That's where, well, I wasn't even sleeping. I couldn't get up.
Yeah.
My wife and my parents sat in that chair, making sure that I wasn't going to take my life, because I was so devastated that I thought I had lost everybody's money, and that I thought that I had ruined my life and my family's life, and that we were going to have to sell the house. And what I determined, that you may not have heard this before, I think a lot of real estate people become compulsive gamblers in real estate and don't know it.
Okay.
That's what happened to me. That's what happened to me. When you're borrowing money and you're out there doing all this stuff and getting loans from banks and leveraging things up, that is no different than somebody who's a stock trader or an options trader or a casino gambler. It's the same mentality. And what happens when you get into that is you start believing your own bullshit, and you start buying more stuff because you think you're hot. You think that, hey, I'm invincible. But cycles come and go, and the cycle came and I almost went. So from that time on, I struggled just to get back to having a net worth of 0.
Yeah.
Just even, because I owed so much money. I was in so much debt. And I want to warn anybody that will listen to really be careful with debt, because it's a double-edged sword. It makes you a lot of money when it works, and it kills you when it doesn't work.
Okay. All right. You've just given me enough to talk about for the next 3 episodes. Okay. I mean, I know exactly where you're coming from. And, we're going to do a deep dive here in a moment, but let me kind of go back through this. First off, getting started. What you described is exactly what I teach my students, and what I say that most successful students of mine have this one ability, this one trait over everyone else in spades that makes them successful. And that is understanding that this business that you and I are in is a sales and marketing business. a guy that goes around and knocks on doors, gets doors slammed in his face, but moves on to the next one. He's a sales guy. He's out there marketing himself. He's getting his name out there, whether it's in picking up clients for mowing the lawn, or whether it's knocking on doors for investors. You're always out there promoting yourself and letting people know what you do for a living. And that is exactly what the best people in this business do. Now, I'm going to come back to 81 in a moment, but this whole thing about compulsive gamblers, you are so spot on. Back in 2006, I was believing my own bullshit. I was, everything I touched, I'll buy it. Okay, yeah, no money down, sure, I'll buy it. And then it came crashing down, and then that's where you start to learn. It's when success is a lousy teacher, and when I had my biggest failures, that's when I learned the most. And one of the things I learned, and as I tell people, the older I become, the smarter Warren Buffett gets. And, one of the things you learn from being a compulsive gambler is patience is the alternative to that behavior. And just be patient, and things will start to turn for you. So let me get to, and of course, debt is a killer, man. I didn't understand that. And, I'll tell you something, Joel, and I might as well ask you about it now, but, depression. And when you go through these periods, and I've had business failures in the past, don't trust anybody that sits there and tells you they've done nothing but make money in real estate, because that's the person you want to stay away from. I mean, depression is a real thing, and it's something that I've learned to deal with through early on through medicine. Lately through cognitive approaches towards depression, and it's something you have to live with, and you just you're aware of it at all times.
Everybody touches depression in some way or another. Some people have it. Some people have it in a family member, a son, a daughter, a parent, a friend, and everyone knows someone who's taken their own life. Everybody knows someone. If you don't know someone directly, you know someone's son or someone's cousin.
Yeah.
Mental health is a big deal. It's interesting that we're talking about this. My dad, who passed away 1 year ago this week at 89, was a psychologist. My mother, who's still living and is 86, is a therapist and still sees 15 people a week.
Yeah.
My daughter, who's living with us while they're looking for a house, she and her husband just had a baby 3 weeks ago. She's a therapist. And the reason that you can't get an appointment with a therapist is because mental health affects so many people that it's difficult to get into a psychiatrist. If you want to go into a psychiatrist and get medication, to get a really good one, you're going to wait 3 to 4 months just to get the appointment. You need to know somebody to get in. So it's a big deal. And when you take a risk in business, or you do something where it becomes a bad habit or an addiction, once you get into trouble, you go down and you hit bottom. Most likely, most people hit bottom. And when you hit bottom, you have two choices. Either you bounce back or you die. It's one or the other.
Yeah.
And 95% of the people bounce back.
Yeah.
I bounced back, but boy, was it a difficult period of time.
Yeah.
And I learned, I lost some investors forever.
Yeah.
I kept others because when I came off the couch, I worked really hard and I brought everything back. We only had one foreclosure out of 50 buildings during that period. And I had a partner who, he was a football player in college. He could have run for president. He was so likable and smart and capable. And he and I were partners with my brother, the three of us at that time. My partner wanted to put everything in bankruptcy to start over. And the reason that he didn't mind doing that is, of the 200 investors, of the $80 million that we had in equity, only his parents and he and 2 or 3 of his friends were investors. Almost all the rest of the investors were my people.
Yeah.
So we got together, we had a meeting with a lawyer, and his lawyer, Jeff, said, we want to put this in bankruptcy so you guys can go start with a clean slate. And I said, the difference between you and me is that these are my investors and you don't give a shit.
Yeah.
We ended up getting into litigation because every step of the way where I was trying to save it, he was trying to sink it.
Wow.
And here's a crazy one. When he was 48, he developed a form of cancer that was aggressive, and he died. And we would still be fighting today if he hadn't passed away. And I feel terrible for his family. He had 2 young kids and a wife who's a cancer surgeon. But what ended up happening is we had life insurance on him, Keyman Insurance.
Yeah.
And the Keyman Insurance covered a lot of the money that he and I still had in guarantees. And unfortunately for him and for his family, it was a terrible loss, but our fight stopped, the litigation stopped, and we had a bank account with enough money to come back. So I have a really crazy story. So after that, I decided that from now on, I'm going to find people who are like-minded with me, and we're going to buy all cash with no mortgages. And if somebody says, that's not exciting enough for me, I say, that's great. Let me give you like 7 or 8 podcasts you can watch with people who don't even mention the amount of debt they take. It's not even in their head. It's like, yeah, we bought this complex in the Sun Belt. And it's like, okay, great. When things go to shit, the Sun Belt goes to shit with it. So,
That is so true. Oh my gosh. These stupid cap rates down there in Phoenix, like three caps. Oh, but we're gonna keep getting 20% increases in the rents. I guarantee you. Yeah.
Or cap rates go down forever. No, they don't.
Yeah.
They go up. They go up. They're up, and they're going to keep going up.
Yep.
We hit a recession, they're going to go up more. I don't sell on a cap rate. That's the other weirdest thing we do. I'm in the industrial real estate business. It's just like your business, but we have manufacturers and distributors in our buildings. And we have a guy that was on Shark Tank who makes protein bars that does $15 million a year in revenue in a 50,000 foot space. We just signed a lease with a guy who was on Undercover Boss in season 6. He's got a limo company that services NetJets and Hyatt hotels, and they do 150 million in revenue. We're in a different business. We have a lot of manufacturers in our buildings, and they're sticky tenants. They stay and stay and stay. The fact that they can't afford to move, they can't lose their employees, et cetera. They can't move their equipment. My group buys those kinds of buildings, and my people like cash flow. They're all wealthy. They don't want to lose their money. They're not looking to make a killing. They're not looking to make a 20 IRR. Anyone who's smart knows that a 20 IRR only works when the market's going up at a fast pace.
Right.
But you can't lose. Warren Buffett does say this. You can't lose. When you lose money, it ruins the whole thing. So I found like-minded people who are happy with a nice little 12 or 14 IRR if the values go up based on a 7 or 8% cash flow, which is the NOI. We distribute our NOI.
Yeah, because it's all NOI.
It's all NOI after the expenses. We have a building we just bought, and we're syndicating it now. And this is the one where
okay, hold on 1 second, because I think you said something that is confusing to most people. You said you bought a building and now you're syndicating it. So,
oh yeah.
Okay, so you didn't syndicate it and then buy it. You already bought it. Now you're raising the money for it. Is that how you do it?
Yes.
Okay.
We don't like being under pressure to have to raise money when we find a building.
Yeah.
So I put together a group of 40 investors. These are my longtime investors and a few new ones. And I went to them and I said, I'm doing a GP fund. And they said, what's a GP fund? Well, that's where we all invest together. We put a load of cash into a bank account and we go buy properties with it. And then when we do our syndication, we charge a small acquisition fee. we do self-management, we do self-construction management, and we take promotes on the end after the investors get their preferred return. And I said, I will share all those things with you, all those fees and all those profits, if you put the money up with me to go buy properties. And then once we own them and position them the way we want, then we'll syndicate them. We can syndicate them. We can take a year to syndicate a property. We don't care. So we bought this property from the people who own the duty-free shops in the airports. They're out of Miami. They lost their lease at O'Hare and their warehouse went on the market. So I bought it with this money from my first group. We bought it for $850,000. And then we spent $1.25 million to fix it up because it was a piece of shit. And then we leased it and now we're syndicating it in increments of $50,000.
Okay, so let me, this is so interesting.
We're weird guys.
Oh no, this is almost genius. Hold on. You're doing it like ass backwards, but I love it. I love it. So you instead of getting a bunch of people together, instead of syndicating a bunch of, well, you did, you kind of syndicated twice. You created the GP.
Yeah.
So everybody became the GP. So we're all share alike at this high level.
Just 40 of us.
Oh, you're just 40. Yeah. It's 40.
I put in 400,000 and another guy put in $1 million and another bunch of people put in 50,000 each and that kind of thing.
Okay. So you got a big pool and you're all partners together in this thing. So it's not like different classes of membership. You're all in the same class of membership.
Equal.
And then you take how much was the fund? How much did you have?
We're at 4.5 million.
4.5 million. You take your 4.5 million, you go and you buy a piece of property for 4.5 million. You buy it all cash. You now own it. Now you bought it at 4.5 million because you saw value in this property. You knew that if you could put your imprimatur on that footprint, you're going to be able to make that an $8 million property. And so once you do that within a year or so, now you go to raise money upon this new valuation. So now you're syndicating that deal. You're pulling 80% out of it, or is that?
It doesn't work quite that well.
Yeah.
I wish it did. It actually, our margins are much lower than that.
Okay.
Typically, so Milt Podolsky taught me as a mentor in 1981 that real estate is a business of the future. It's not a business of now. You just have to live long enough and own your stuff long enough that you become rich over time, not the first day. You know, everyone who says, I'm going to make you rich right now. It's like, okay, great. Yeah, that's sure. So,
hey, Joel, I heard all the real estate sage told me that all real estate makes money. You just have to own it when it does.
Yeah, you just have to live long enough.
Exactly.
Yeah, yeah. So, I mean, like, I went through 2008, and as I said, my net worth went negative. I owed more money than I had. So
yeah,
that means that I had a negative net worth.
Yeah.
When we buy a building using, our fund is called Brit Co-Sponsors because we're all co-sponsors. And my partner, Eric, and I run it. And that's another thing. The first question that everyone should ask a syndicator is, what's your succession plan? Because you sound like you know what you're doing, but what happens when you get hit by the car?
Right.
You know, who am I stuck with?
Right.
So Eric and I run this, and he's fabulous. I mean, he's an operator. He's not a salesman. I'm the sales guy.
Yeah.
I bring in the investors and I find deals. He finds deals, but he's an asset manager. And if I were to be dead tomorrow, I gave him a list of things to think about. And one of them was, if Joel died tomorrow, what would you do? And I want to know what he would do. My investors want to know. And they want to meet him, by the way.
Yeah.
Because it's really important.
Yeah.
But it's not as good as what you think. What happens is if we buy a building for $2 million, or we own a building that cost us $2 million, that's where I syndicate it. I syndicate it at the level that it's at. I don't mark it up.
Okay.
I never mark it up. It's all transparent. So in my private placement memorandum, I actually show people the numbers on one page. It's here's what we bought it for, here's what we spent, here's our acquisition fee, here's our carrying cost to get to this point, and then this is what we're syndicating it at. So no one who goes into our syndications feels like we're making all this money in the Brit co-sponsor. Brit co-sponsor is a convenience.
Yeah.
Let me tell you where they make their money. They make their money by sharing fees with us. So they also invest. Brit co-sponsors puts money in every deal.
Mm-hmm.
So every deal, Brit co-sponsors owns 5% of the equity. So they make money deal after deal after deal by owning a small piece. But they also, when we sell the property, if we do at some point, they make a portion of the promote. And that means that if there's $1 million profit, and the promote's 20%, which means our group gets 200,000, they get half of that. So there's a lot of money to be made being on the operations side, but the deal has to work first. And there's no such thing, as you know, in this market as buying anything for half of what it's going to be worth in a year. It's theoretical, but I'll tell you where you're right on target is how they make a lot of money. Last year, we put a property under contract to buy, Brit co-sponsors did, owned by the local gas company that serves the 4-state area, Illinois, Wisconsin, Michigan, and Minnesota, I think, called People's Gas. 6-acre parcel, 60,000-foot building. And we were going to buy it. And we put it under contract for $3.5 million, which would have been easy for us. We could have written a check. Right now, by the way, all that money's in T-bills, earning 4% until we need it again. So we put it under contract, and our earnest money was $200,000, and we did due diligence for a few months, $30,000 worth. And during due diligence, an industrial real estate broker brought me a company that's down the street that does hog processing. The guy kills 1,000 hogs a day in Kankakee, Illinois, in what he calls his kill plant. And then he has in cold trucks that are refrigerated trucks, brings chopped up hog bodies to Chicago, where he's got 80 butchers that chop them up and make bacon and ribs and pork chops, and they package it and they sell it. And they do millions of dollars in volume. And he needs to be in the city because his 80 people that work for him need to keep working for him, and he doesn't want to move far away where he's going to lose his key people that know how to chop up a hog. You know, you don't know how to make bacon. I don't know how to make bacon. These guys know how to make bacon. So he needed the building, and a broker, an industrial real estate broker, brought this guy who was his client. His name's Harry. And Harry walks around the building with me and with his broker, and he says,
now you have the deal under contract. You don't own it yet.
I don't own it yet, but I'm buying it.
Yeah.
And Harry says, how much do you want me to give you not to buy this and let me have it? And I said, I don't do that, which, by the way, I have done that. I don't look to do that. I said, we're buying this building because we want to own it. It's a great location with a great building and a lot of land for parking, which is what industrial needs. Yeah. And he said, okay, I will give you $1.5 million not to buy this. And I said, well, you know, it's not what we do. And he said, just take it. He says, what have you done? You haven't done anything. Just take the $1.5 million and move on. Now, between then and the time we closed, we found an environmental problem. We found structural problems. The price came down. Harry's spread of $1.5 million came down to $1 million. But my co-sponsors and I had the right to that money because we hadn't syndicated it yet. So the co-sponsors who put all that money up, including me, got 80% of the profit that we got on not buying the property. And my partner, Eric, and I got 20%. That's our promote on a flip.
Yeah.
Every fourth building that we put under contract in industrial is a flip within the first year. And that's where co-sponsors makes their money fast.
Gosh, that's amazing.
So everyone that I tell about co-sponsors and how I do industrial and sell to users, I don't sell to investors. I sell to people who are going to move in and use the building like a tool for their
Right.
business. Anyone I tell about this deal and how I work and how we find deals has gone in. There's been no one who has said no.
Yeah.
So it's been a fascinating deal. And there are other co-GPs. If you go to Crowd Street, they occasionally have a co-GP that they put on their offerings.
Let me ask you this from a theoretical standpoint, Joel. How is what you're doing now different than what you were doing as a broker?
As a broker, you have no skin in the game from a money standpoint, only time.
Yeah.
So as a broker, you can, as an industrial broker, the industrial brokers today, there's 300 of us in Chicago. We belong to an organization called SIOR, Society of Industrial and Office Realtors. It's an international organization. And I belong to an organization called AIRE, A-I-R-E, the Association of Industrial Real Estate Brokers. To get into industrial, you need to be mentored by someone in and be brought in by them, or you're not taken seriously. So the Podolskis, who I worked for, were presidents of SIOR, presidents and board members of the Association of Industrial Real Estate Brokers, very entrenched. We all know each other.
Yeah.
When Jim calls me, say, "Hey, Jimmy, how's your dad doing?" That's what it is. And being a broker in Chicago today, of the 300 brokers, I'd say at least 50 of them are making 7 figures. It's a much easier business because you don't have to worry about the due diligence. You leave that to the client who's buying the building. You don't have to understand financial statements of tenants. You don't have to understand how the municipalities work with zoning laws and environmental problems. You advise people as a broker, but you don't take the risk. Now, when I put a building under contract, I have to understand it from literally 13 or 15 feet below ground all the way to the roof so well that when we close on it, we know what our exposure is and we understand what we're getting. So this is the way you take gambling out of real estate. You do due diligence better than anybody. And that's the key to the whole thing. Then it's not gambling. If you throw an 80% loan on it, it might be gambling. But in our case, great due diligence plus all cash, no mortgage is not gambling to me. And that's my boundary.
Oh, that's fantastic. You're absolutely right. You're spot on. That removes all risk. Well, yeah. Okay, but hold on. Let me, obviously you're going to buy insurance for certain unforeseen risks, but the market, and here, I always call on my buddy Paul Moore that,
I love Paul Moore.
Oh, do you really? Hey, is he one of your guys? Does he bring you money?
We have talked about it, but we haven't done anything together yet. He is picky, man. We're not big enough for him. That's the problem. My deals are too small. He's got a bigger chunk of money.
Exactly.
I do deals. I only have 3 million available, and I have 200 investors who, not all of them go into every deal, but it fills up my deals.
Yeah.
And so if he came in with $5 million into a deal where I had a $6 million deal, I'd only have $1 million left for my people.
Yeah.
So I'd love to do something with him, but I'm not big enough.
Wow. All right. Well, our friend Paul Moore made a great statement. He says, we are investors. We don't care what the market does. We know how to unlock value in the real estate. If the market goes up, great. If the market goes down, okay. But we make money by understanding how to unlock value in the property. And so, when we were just talking about the due diligence and, buying at the right price, getting that thing filled with the right tenant. I mean, that removes most of the risk. I mean,
it helps. Yeah, it helps. But okay. So if you want a list of my risks, I could send you my risk list.
Yeah.
It's still there. So our biggest risk in industrial, in our case, we have a great formula, but it's not perfect. So our formula is buy a building that has great geometry. Great geometry means a high ceiling, good loading docks, and lots of parking. We can give up some of that. I can give up a little bit of parking if it's a great building in a great location. I can give up a ceiling height if it's a great building in a great location, but I can't give up all three.
Yeah.
Okay. So here's the risk. You buy a building where something's wrong with the geometry and the market goes bad and the tenant's lease comes up and they leave. So my three biggest risks are vacancy, vacancy, and vacancy.
Right.
With you guys, with your apartments, with multifamily, you have a different issue unless you make a giant mistake and you buy something where everybody moves out. If you lose out of 100 units, if you lose 6 or 7 tenants in a year, you can still pay your expenses.
Yep.
But if my tenant moves out, I have to refill the building really fast because every day is a full 100% vacancy.
Yeah.
So my risk is vacancy. That's the number one risk. I have other risks. One of the things you never think of is the water main between the street where the water runs for the entire town, all around all the streets. The water main connects to the building underground. And so when those get old, or if there's a problem, the water main can break between the building and the street. And then you start having this water bubbling up. So I'll tell you our second biggest risk, water. Water is our enemy. Roof leaks.
Okay.
Bubbling up from the underground, flooding, rain coming at the building where the windows aren't exactly sealed perfectly across the top of the warehouse, where the rain comes at it and it starts coming in and making the walls wet.
Yeah. Joel, let me just tell you something. This is when I teach people about due diligence. And I teach them that the first thing for physical due diligence is as you're driving up to the property and you're looking at the property, you have to ask yourself the question, where does the water go? Because the number one killer for multifamily properties is water. It can, and number two is our sex offenders. Number one is water. Number two is sex offenders. That's the biggest killer of water. So that's a fascinating that.
Yeah, I get it. Thing. Right.
Yeah.
Yeah, remember that that movie with Jack Black where they invented this spray and they sprayed the dog shit and the dog shit disappeared and nobody knew where it went. And at the end they found out where it went.
I don't know movie.
Your water might disappear while you're looking at the building and you don't realize it. But think about the parking lot and the slope of the parking lot, which way the water sheds off the site.
Yeah. Exactly.
And where the water sheds off your neighbor's site and how the sewers work. It's just civil engineering and roofs are a really big deal.
Oh yeah. I tell you, when I was just with a civil engineer the other day and we're looking at the map and the way he looks at the topography on the map and he's like talking about and how many feet that is, the rise there. And these guys are just so brilliant at their job and they can look at that map and they know, okay, we're going to have to redirect this driveway over here. I'm like, oh my gosh, this guy's awesome. He knows what it's all about.
Yeah, they're awesome.
Yep.
In Chicago.
I could talk to you forever, Joel. This would be, and I'm out in Chicago once a quarter. I got to connect.
I know you're coming here this summer, right?
I'm coming in this summer for the hotel to apartment conversion.
Let's have dinner.
Okay, that'd be awesome. Dinner. Awesome. We're doing it. Okay, so here's my question to you. You mentioned that real estate is a future business, and you said that the past, past doesn't repeat itself, but it rhymes. Let's talk about what you said regarding the similarities and what you're seeing between now and 1981. And what are you doing? What have you learned from all of that to protect yourself or take you into the next 20 years?
Well, so in terms of protecting myself, there's nothing that I can do anymore if it's 1980.
What you're doing now?
It's too late.
Yeah. Okay.
We're too deep into the trouble if rates go up any higher and it stays high.
Okay.
Okay. So what we're rhyming with right now is 2007, where there's been just too much exuberance by buyers, inexperienced buyers, people coming in who don't do due diligence well, who get themselves into trouble, who borrow too much money.
Yeah.
It feels like 2007 to me right now. And the reason that it does is because I can't buy anything that makes any sense. And that's what happened to me in 2007. Now, in 2007, my deceased partner, who made money on acquisition fees and was crazy out there trying to buy buildings while I was bringing all my investors in and trying to make sure that they were safe. I thought they were safe, but they weren't. This feels like 2007. So this winter, my son and I, he's in the business with me. His name is Sam. He's 28. Went to Florida for a month. My wife came and went to meet with our Florida investors. And I made a commitment that during the month of January and into February, I wasn't going to buy anything because the prices were too heated up and I wanted to wait and see. I don't have the pressure. If someone has a fund, you know, that they have the pressure of having to go buy stuff.
Yeah.
Okay. We don't have a fund. We do it property by property. And today we keep our cash in T-bills, which on a 30, 60, 90-day basis are paying between 4.5% and 5.25%, which is nuts. So we have no pressure to spend this money. So Sam and I went to Florida and we met with 17 investors for lunches and dinners. And I said to him, one of the things I'm happy about being in Florida, we're going to stay out of trouble. We're not going to overpay for stuff because right now is not the time for me to be buying much. Warren Buffett or whoever it was that said, or maybe Paul said, you can buy stuff at any time. I don't agree with that. I think it's very difficult to find a good deal at this time.
Yeah.
I have 2 right now that I've got offers in on. And I just walked away from 3 deals where I found some problems during due diligence. If these buildings aren't exactly what we want, I can't buy them because even if we keep them long term, if there are problems that can't be solved, they don't get any better with time.
Right.
So right now I'm being very careful. I'm not buying much. I am trying to buy some things, but it's tough. 2007 was what this is just like that. And I think that there is going to be some kind of a pullback or recession. Industrial's booming because of e-commerce.
Yeah.
Industrial's gone up while everything else has gone down.
Yeah. And I mean, you can't find industrial space anywhere around here. It's crazy. Now, you said, you know, first off, you referenced your partner and that he made his money like through the acquisition fees.
Yeah.
I'll tell you something, Joel, that is the biggest problem. You see these, you know, novice GPs out there who are doing the stupidest deals that have no meat on the bones. There's no upside. But you know, like the last one I looked at was a $50 million deal these guys were trying to do. I looked at it, it was for one of those shark pools where I'm one of the sharks. I'm the mean shark. And because I say no. And I looked at it, I said, there's nothing here. I'm looking at CoStar. Your rents are at market right now. Why are you paying top dollar? Because it's a $50 million deal. And you know what their acquisition fee is, Joel, on $50 million?
$1.5 million.
3%.
Yeah, $1.5 million.
Yeah. Yeah. And that's why they're doing it. It's like, that's crazy. Smart Wall Street investors don't get involved with a syndication where the promoters are keeping 3% on a $50 million deal. I mean,
yeah,
no skin in the game.
Yeah. So the way that I make my living is on long-term ownership and the promotes. Yesterday we sold a building. We had owned it. My partner actually was the one who bought it. It's one of his really good deals. 100,000 square feet. The tenant is a company that's a division of Reliance Steel, which is a New York Stock Exchange company. And this is their division called Viking Materials. And they take giant coils of steel and they chop them into squares and rectangles and sell them to companies that use them in manufacturing. And they bought the building. I was stupid enough to give them an option to purchase. And we bought it for $2.5 million and we sold it to them yesterday for $5 million. And my investors came out pretty well, but they've owned it since 2007. If you think about that, what's that, 16 years, 17, whatever. So we did okay, but it took a long time to make that much money.
Right.
And my brother and I are co-partners in it. So we have an investment in it, and there's a promote. And the promote is the uneven portion of the proceeds where we get something for putting it together, and it's 30% of the deal after the investors get their preferred return, and their preferred return is 8. So first they get 8, and all these years they've been getting 8%, 9%, whatever it is, and then we sell it, and there's a profit, and we take 20% of the net profit after all expenses. So that's how we make our money. First, the deal has to be successful.
Yeah.
You can't suck out the money in the beginning. They call that load in the stock market, or when people put together deals. The load is huge. You got to look at what that is. Our load is very little. It's shared with my co-sponsor, so we don't make much money on that. We make money when we accidentally flip a building, like we did with Harry with the hogs. And when we own something for a long period of time and the value goes up and we make a lot of cash flow. So you're right. I mean, the people who are doing deals that are thin just to get a deal under their belt, and then they're saying they're only going to own it for 3 or 4 years, that is such bullshit. Real estate is not a 3-year hold. Why would anybody, if I buy a great building, why would I ever want to sell it?
Yeah.
Wealthy families don't go around buying and selling buildings.
Yeah.
They own them. They keep them. They own them like 40 years later. The grandchildren are talking about, yeah, I'm glad Grandpa bought this building.
Yeah, exactly.
How do you replace the best building you've ever bought?
Yeah.
You can't replace it.
I tell you, Joel, I had the same conversation last night on my Monday Night Live call, and I call it, you can do it the passive investing model of buying, which is what everybody's out there teaching right now. Oh, you can be a passive investor, or the Warren Buffett model, which is where you are accumulating assets and you're holding on to them. And the way one person likened it, just what you described, is these people will get rid of it in 3 to 5 years. They are the equivalent of the fix and flippers for multifamily. It's these guys who, I mean, so many of my students come to me after years of fixing and flipping single family homes because they're sick and tired of that game. You're only as good as your last deal. They're looking for cash flow. They don't get it from fixing and flipping. And now they want to get into this side of the business, the multifamily business, but they're bringing their fix and flip mentality with them. And they think, well, we gotta sell this property and we gotta move on to the next one. No.
No, that's gambling. That is gambling. That you may as well go to Rivers Casino, which we have here in Des Plaines. It's owned by a family here that's a billionaire family. Do you know why they are billionaires? They own the casino. They're not the gamblers in the casino. They don't go in and play blackjack to make money.
Yep.
So who you're describing are literally nothing more than people who are gambling and don't know it.
Yeah.
They don't know it, but they're doing it. And those guys end up in trouble so often. I have this horrible story of this friend of mine's father who bought a building when he was 82. And he was a gambler all his life, and he had a lot of money. And he bought this building in 2007 with a big load of debt. And everything went to shit. And he lost the building. The lender took it. He lost his equity. He carried it for a long time before he lost it, trying to save it. And he ended up having to move in with his kids at age 82.
Wow.
He couldn't support himself. His Social Security wasn't enough. He blew his money by gambling on a real estate deal. He didn't really know what he was getting into.
Yeah, those guys don't realize that real estate's not a gambling business. It's a long-term strategy.
Yeah. But there are people who are flippers. And if that's what your stated goal is, and you tell your investors, we're going to be gambling. We're going to be buying stuff and trying to get out of it quick, like a hot potato.
Yeah.
We're going to try to sell it to someone who will take a lower cap rate than what we bought it for, or we're going to raise the rents, or we're going to redo all the countertops, or whatever it is. That's fine. But tell your investors clearly, I listened to this guy on a podcast who is saying this is gambling, and I'm acknowledging whoever this guy is that's buying those things for 3 years, he should acknowledge that he's gambling, and people who like gambling should gamble with him. That's okay. But when you don't know it and you're doing it and you think you're investing when you're just gambling, that's just really not being self-aware. That's a lack of self-awareness to an extremely high level.
Yeah. All right. Before we hang up, there's one thing I got to do. Give me 10 seconds. I'll be right back.
Sure.
Okay. I cannot hang up with you without bringing to everyone's attention on this podcast. You know, fortunately, some people just listen to it, they don't watch it. But if they watched it, they would see your what I would think is your cereal of choice on your desk. And I just have to say, I had to go grab mine. And so here we are still eating children's candy. You know, it's like that Jim Gaffigan bit where he says, you can't have cake for breakfast. Here, have a donut. You know, Cocoa Krispies.
That's my snack.
Okay.
My diet. I'm trying to lose 15 pounds.
Good for you.
And I love chocolate. So instead of eating the really dense chocolates, I'm just like snacking on a little handfuls of Cocoa Krispies to lose a few pounds.
Unbelievable. Who are
my
we?
diet? I'm on the Cocoa Crispy diet.
Yeah, exactly. I never heard that one. I can't wait to see that one coming up on my TikTok feed from now on. So, Joel, listen, it was so great talking with you. We got to meet when I'm in Chicago. I also go to Dan Sullivan's Strategic Coach event every quarter in Chicago as well. But let me ask you this: how can we get a hold of you? It's BritCoSponsors.com or
no, that's the co-GP. It's
okay.
Brit, BRIT, properties, plural.com, Brit Properties. And we've got a few videos, and we've got the offerings that we have put together, including if you want to read Brit Co-Sponsors, it's on our website. I've got the PPM for it on the website.
Okay, that is great. So you can pull down the PPM for that particular raise that you have, the fund that you have, which I think would be a fascinating read. I want to find out how exactly you do it.
Yeah.
It's really, really cool.
Yeah, and the other thing, we have a PPM for a deal that we bought that we're finishing syndicating right now. We just have a little bit of room left for some
very cool.
Some new. We leave room for some new people in every deal.
And folks, if you want to see what Joel looked like 20 years ago, you can go to look at some of the pictures on the website too. So this one woman said to me, Charlie, when are you going to change your profile pic? It doesn't even look like you anymore. My God, geez, for crying out loud.
Well, I have to give you lots of credit. I think that your podcast is as good as anybody's. I've watched a lot of them, and I think you ask great questions. I think you have fun. Your guests have fun.
Yeah.
I give you a lot of credit.
I appreciate that. I have a blast with it. Hey, by the way, you got to say hello to my number one listener, my brother Lenny.
Lenny.
Yes, he's now sitting in his laboratory wondering, like, why did it take all podcasts long before you mentioned my name, Charlie?
Hi, Lenny.
All right. Hey, Joel, let's keep in touch. It was great talking with you.
Thanks, Charlie. You too.
Take care, man.